The AIM market is now 25 years old. It's been through a number of quite significant changes, and it's lost some money for people over the years, and it's certainly made quite a lot of money for people. AIM is not exactly a unicorn theme park, but a reasonable number of unicorns has emerged from it, and we've been lucky enough to ride on the back of one or two of those. AIM offers significant tax incentives for investing. Tax clearly shouldn't be the driver to investment, and nor do we claim to be tax advisors, but the tax incentives are relatively clear and worth understanding. In comparison to investing in unlisted companies, which is something we do also have experience of and continue to do, it does provide a degree of consistency in reporting and enforcement of governance standards, which, whilst not always perfect, are certainly a lot clearer than for unlisted companies. So it's not to say there are no issues or pitfalls, and we will cover some of those. This isn't the NASDAQ market, but it is interesting. So, as I say, it's seen a number of tricky years, but it does seem to be coming into its own. The market cap has rose to 131 billion last year, and it's now almost 150 billion. Last year in COVID, reasonable amount of money was raised, largely, particularly initially, to ensure companies stayed in business, and shareholders were actually very good in coming forward with funds to keep companies in business. And most of the money raised last year was for secondary issues, over 5 billion, which was in fact the largest amount raised since 2010. If you look at the columns on the right, the furthest right-hand column, you don't need to read the scale, was I think to the end of May, by which time almost as much money had been raised as for all of 2020. So we're at the moment on trend to raise twice as much as last year. And so far this year, we've seen 30 new companies come to the market, 30 IPOs, which is more than all of 2020. Slide, Rosie. Whoops. Got the next slide. Almost. So it seems to be working as a marketplace very well for life sciences and tech. Again, you may not be able to see the labels, but you should be able to see the colors. On the right-hand side, we've got the market as it looked 10 years ago. The big brown block, the size of the blocks is the relative market cap. The big brown block is the energy sector, and the big grey block is basic materials, so mining, and they accounted for almost half the market. If you see them now, basic materials has disappeared down into the bottom right-hand corner, and energy is still there, but far, far less. So the market, which had a reputation for being a sort of wild and woolly place for emerging market mines and energy, very speculative energy exploration companies, oil exploration companies, has changed characters completely. One of the, in fact, the biggest things that's emerged over the last few years has been some of the internet retailers. So ASOS and Boohoo are the two best known, and they're a big part of that block on the left-hand side. However, what you can also see, the light grey next to that is healthcare, and the blue block next to that is technology, and the block below healthcare is industrials, of which there is a fair bit of technology as well. So they've become much more significant parts of the market than used to be the case. Next slide. Yeah, a couple of slides just on the scale of the market, but particularly on the secondary market. So that's the slide on the right. You can see that the volumes really have picked up. Liquidity is not consistent. It's a market maker driven market, and the market makers are not enormously well capitalized. So you certainly can't be sure that there will be consistent liquidity in all stocks at all times. But it is possible. It is possible to trade. Right, and that will be the end of the slides. So just to backtracking a little bit, if you go back, the peak of the market in terms of the number of stocks listed was actually 2007. So before the financial crisis, there were over 1,700 companies listed. Average market cap was quite considerably below 100 million sterling. The peak number of IPOs in 2005 was almost 400. So that compares with 30 for the first half of this year. Many of them were absolutely tiny and came to the market really way before they should have done. There was a big clean out in the global financial crisis, which coincided with the end of the so-called super cycle in resources. And that washed out a lot of companies that should probably have never been on the market, but also unfortunately removed some of the institutional interest. It then went through another tricky period around the time of the Neil Woodford debacle of what, 4 years ago now, where Woodford had very concentrated holdings which had to be liquidated at bargain basement levels, and this concentration was amplified by him having worked with a couple of other funds who tended to have strangely very similar holdings. That really is out of the market now. Institutions have been coming back. It would be good to see more. On the other hand, that would be more competition for the interesting stocks there. But the market has definitely revived, and the underlying things working in its favor, so the continued availability of enterprise investment scheme and venture capital trust tax breaks have supported new fundraisers. The venture capital trust managers, firms like Octopus, have continued to grow. The inheritance tax break, which is on many AIM companies, remains there, and that's further attraction. Has to be said, that's not without political risk over time, but it seems pretty embedded at the moment. EIS at 30% is a big advantage to the market, and I think it would be a brave politician to interfere with that. So 30% tax and the opportunity to shelter capital gains is important, and there doesn't, touch wood, appear to be any great risk attached to that. However, accessing new issues with EIS is not straightforward for private investors. And one of the services that LGB provides is to work with suitably qualified private investors to help them gain access to what would otherwise be institutional offerings. And those remain the main way in which money is raised. Stepping back a bit, because there is a lot of talk in the press and elsewhere on reform of regulations, one of the things we'd love to see would be a change in the prospectus directive, which was designed to protect investors, but in fact actually locks a lot of investors out of the market. Interesting companies are definitely raising money at the moment. We continue to see very exciting companies, often very early stage, but raising sensible amounts of money that should keep them going for a period and not lead into cash crunches, with managements who, whilst they may be new to their companies, have track records elsewhere with good IP. And Simone will talk a little bit more about the way that we look for companies. And we're also starting to see some new classes of investors come into the market, particularly the American so-called crossover funds, who are venture funds, who in the US would be investing only in private companies, but see in AIM a way of getting into companies with IP and potential that they wouldn't otherwise otherwise have. This isn't NASDAQ. We've got to be realistic about the market scale. So the entire AIM market is only about 1% of the whole of NASDAQ. Tesla alone raised more money last year than was raised on AIM. And NASDAQ sees, I think, 1.8 billion trades a day. AIM is not much over 100,000. So you know, the London Stock Exchange would love to see this as another NASDAQ. It's not, it's a different animal completely. But here's also an opportunity, because these days companies can't get listings on NASDAQ with a market cap of that much less than $1 billion. AIM is still seeing companies coming to the market occasionally with market caps of under 20 million, certainly raising under 20 million. The biggest AIM companies are only the same size as the average for NASDAQ. So it's a different scale, and it does mean that that we are from time to time seeing companies who might have an ambition at some stage in the future to move to NASDAQ, but it's not practical at the moment. And really that is an opportunity. There's one company which is IPOing at the moment that we've been looking at and think is very interesting, which is actually a Texas-based company, but it has sufficient UK operation to have EIS, and it's coming to the market because a couple of companies doing what they're doing, which is AI-based diagnostics, have very successfully listed on AIM, one of which is now I think a dollar unicorn. So you know, you have a different venture capital structure in the US. The venture capital industry in the US is very supportive of early stage companies, whereas private equity in the UK has not historically been so much the case. And this does mean that investors, ordinary investors, can get a crack at early stage companies with interesting technology that would otherwise be restricted only to venture cap. Just a few words of caution to end up. It isn't all rosy in the garden. We've learned some lessons over the time we've been investing in AIM. You have to be careful of companies raising too little money, who are then seen as obvious candidates for repeat raises. There are the light touch governance does occasionally raise one's hackles. For example, there's no shareholder authority over remuneration. Occasionally you get managements who take advantage of that. Managements can be entrenched. I think the likelihood of external bids is smaller because the costs of a bid relative to the market cap are disproportionately large. Broker research is patchy. A lot of companies are only covered by one broker, and very often what they do is pretty much a rehash of companies' own releases. On the other hand, AIM Rule 26, which came in a few years ago, does mean that that actually companies' disclosure is really not bad and easy to find. And broker research, although since MiFID has become a bit restrictive, we find we can get information on pretty much all the companies that we're interested in. So we see interesting companies, and we're confident we can continue to show our clients interesting opportunities.